Good afternoon, everyone. If we could reconvene for our final panel of the day, please. Thank you all very much. We'll call you up in order. So we've had two rounds of pretty deep analysis and we hope, and now comes the fun part. Joking aside, as is customary in this sort of thing, we now get, in a sense, the policymaker panel. But we are blessed to have, blessed overstates slightly, we are glad to have three very distinguished speakers to take us through this from the perspective of one from an international organization and one from the Emerging Market Central Bank and one from the Center of World Markets, but each of them a distinguished researcher and thinker in their own right. First, we'll have Olivier Blanchard, who, as of this month, is now the Fred Bergston Senior Fellow here at the Institute, the first occupant of that chair. Olivier, of course, just left the International Monetary Fund, where during a time of great service and need, he was the economic counselor and director of the research department for 7 years, from 2008 to 2015. He remains the Robert M. Solow Professor Emeritus at the Massachusetts Institute of Technology, where he taught from 1982 to 2007. He will be followed by our colleague, Jose de Gregorio, who is, of course, a full professor at the University of Chile and is a non-resident senior fellow here at the Peterson Institute. He's with us multiple times a year and was governor of the Central Bank of Chile from 2007 to 2011, previously vice governor from 2003 to 2007, minister of the economy and mining from 2000 to 2001 in his native Chile, and is a self-confessed currency manipulator last time he spoke at the Institute, which may have some relevance for today's remarks. Third, we're delighted to have with us Guillermo Modino of Citigroup, who's joining us. We're very happy to have Citigroup as one of our supporters and also an intellectual exchange. We've had many interactions with our board member, Peter Orszag, with their chief economist, Willem Bouter, recently. And now, of course, to have Guillermo, who is the managing director and head of emerging market research and strategy at Citi. He has a PhD from Yale and previously had worked at Barclays and other banks in the world and now sits astride the top EM team. So first, Olivier, please.
Good. I think that you got 4 outstanding presentations today. The one by Steve and the Fed is incredibly nice. It gives you a set of numbers that you can use to do back of the envelope. Actually, some of them were created doing back of the envelope, but, and it looks incredibly clean and simple. And if it stopped here, we would think that we would know everything. But the other papers show that maybe the world is a bit more complicated when you go away from the world of DSGs and back of the envelope models. I have 2 worries, so these will be comments on the papers. The first one is about identification, and it's not just a narrow econometric issue, it's really a big issue when we want to talk about the effects of monetary policy in general. That's just one more context in which the issue arises. And then the other is whether the magnitudes from the different papers are consistent, and we saw already today that there are some inconsistencies or differences at least. Then I want to take two larger questions. The first one is go back to the big question behind all this, which is conventional monetary policy different in some fundamental way from unconventional monetary policy, both domestically but in the context of today across countries. And then the last is the normative implication. So even if we understand what it's doing, can we do better? Is there room for coordination? And if so, what? So this is the plan for my remarks. On identification, and the problem is we look, say, at the change or the unexpected change in the long term, which is more or less the same in this case, the long term 10-year US bond yield. And the question is, where does it come from? And that's a big issue, right? And that was discussed today. It can be news about the economy, where presumably this is probably good news. It can be news about the reaction function. That's presumably bad news. It means that the Fed is tightening more than expected. It may be no news, just a change in risk appetite because of something which happened somewhere in the world. And that would have ambiguous effects, but probably negative effects on activity. Then there's a fourth one, which we didn't talk about, but I thought about after having made the slide, which is inflation. I mean, we're looking at nominal rates. We're not looking at real rates. And so, as we know, inflation seems to have its own life at this point. And so a shock to inflation may well move the rates, and then you have to think about what this would do to another country. And it's clear that the implications for output, which in the end is what we want to learn about, or the main thing we want to learn about, is going to depend very much on what is the cause of the increase or the decrease in the long rate. So we saw various ways of doing it today. The first one is the one that the IMF, Prakash and Esteban have followed, which strikes me as a very good beginning, which is that presumably at least 1 and 2, what they call the money and the real shocks, should have different effects on stocks and bonds. And so it seems to me that that's a useful way of looking at both, basically tells you something. The issue is that they extended the analysis to allow for the third shock, which we know is important, but they still only look at stocks and bonds. And so you have a problem of 3 shocks and two assets. And the way they do it, I think, is dangerous, which is that they first regress the bond and stock returns on the VIX, and then they take the residuals and work with the residuals to see how much is money, how much is real. But that implicit assumption is that the VIX is uncorrelated with money and with real, which is unlikely to be true. I think somebody said today, many of the movements in the VIX come, at the same time as there's something surprising happening to the economy or happening to monetary policy. So that when you've cleaned in this first stage, when you've put the VIX first in off-organization, then you're likely to have taken out a lot of the effects of money and real when you actually look at their effects. So my sense is that's the way to go, but it's not quite there yet. And for the moment, I would have some doubts about the results. I think it just takes out too much. The identification that Joe takes is, I think, a very smart one as well, which is to look at the announcement and non-announcement days. And there, I think it goes in the right direction again. Joe was very explicit about the fact that on the announcement days, you still have news about the economy. So it's not quite pure, but presumably there's relatively less news. I think it's also true of non-announcement days the other way, which is that, if somebody on the FOMC makes a statement to the press, this may have just as much effect in terms of indicating something about the position of a board member as an announcement on the FOMC day. So it goes in the right direction, but again, it's not pure, but it's getting at it. And I think that the approach that Reuven is using is very similar to Joe's in spirit, with the same limits. So this is a very hard nut to crack. I mean, that's a very old nut, hard to find exogenous movements in monetary policy, which we think should be very rare. But it is not something which has been, I think, completely cracked. So I will want to see a bit more work before I'm totally convinced. I tried to, and the papers differ in many ways in the terms of, the time dimension that they look at, the sample that they look at, the methodology that they use. But I tried to put the results together, and this is what I got. So the effects on the exchange rates, which are high frequency, I think, for all the papers, that Steve came with 25 basis points down, gives $1% dollar depreciation. Reuven came, I think, with roughly the same number. And Joe came with a number which is not the one on the slide, which we just clarified. I had not understood fully what the units were in what he was doing. It's a 0.5%, right, Joe? 0.5% depreciation. Okay, 0.4. So there's still a bit of a discrepancy, but it's not as big as I made it on the slide. So, as these things go, not too bad. The effects on stock prices, I think Joe was very explicit that on FOMC days, when you see the long-term yield go up, it is very likely to come from monetary policy being tighter, and you would expect the effect to be negative, and it's not. So it means that there's quite a bit of information about the rest, even on those days. I think it goes back to my previous slide, which is even on those days, there's a lot of information coming, and the FOMC may be very uninformative. So here I think we're not sure that the identification is really strong enough. The last one on the effects on foreign output. So initially I thought there was a difference in sign, but it's just because they look at different movements in the long-term yield. So if I'm right, Steve gets that if you decrease the long-term rate, if there's a decrease of 25 basis points for the long-term rate, that leads to an increase on net of 0.25% in foreign output, right? I got the units right, I think. And then the paper by the IMF gets that if there is a decrease, they look at an increase, but if you reverse the signs, a decrease of 25 basis points in the long-term rate, then you get a 1% increase in industrial production. I think these are not inconsistent numbers because industrial production is likely to be affected substantially more than output. So again, fairly good news here, which is these different methodologies seem to be getting results which are roughly consistent, which is good news. Okay, so let me step back and think about conventional versus non-conventional monetary policy. I thought I would start with debunking. It probably doesn't need to be done here, but I've heard it so much when I was at the IMF from policymakers, various countries, debunking the so-called wall of liquidity of a tsunami. And this notion that if the Fed increases its balance sheet by 100 billion, then there's 100 billion which flows to the other countries. And how can they accommodate that flow? And that just is totally wrong. And the way to think about it is either conventional or unconventional monetary policy is an asset swap. It's money for something, right? And so in the case of conventional, it's typically money for a short-term bond. In the case of unconventional, it's money for a long-term bond, presumably government bond in most cases, but it could be something else. But it's basically an asset swap. So it changes the term structure or the structure of rates of return, but there is no wall of liquidity or tsunami or anything like this happening. This in turn leads investors to think about whether they want to reallocate their portfolio, and it leads to capital flows. But it is in no way mechanical that the size of a balance sheet of the Fed and the size of the capital flows are related in some way. I mean, it's much more complex. But, this is one of these fallacies that you have to debunk every month or every year. It's so appealing at some intuitive level that it's hard to kill. Now the question is, suppose that that's really the way to think about it. It's an asset swap, but of a different kinds of bonds, long-term rather than short-term. So in the conventional monetary policy, the effect on the long-term rate is mostly through expectations. I mean, Jeremy Stein has shown that there is some effect on the premium. But the idea is basically expectations of short rates change. This leads to a change in the long rate. That's the primary channel. And when you teach students, that's the only channel you actually mention. Unconventional is different, right? It basically is a change in the long-term rate due to the term premium, trying to decrease the term premium by basically increasing the demand for the stuff. Okay. But in the end, it's a change in the long-term rate. Now the question is, suppose you're an investor and the long-term rate has come down. Do you care about which of the two it is? Is it because of expectations of short rates, or is it because of a change in the premium? And the answer is yes, you should care, actually, so that the same number doesn't have the same implications for your trading strategy, right? So let's just think about it. Why would the effects of conventional and non-conventional policies be different? And there are two reasons. The first one is that the reaction function of the central banks, the foreign central banks, may be different, right? This would lead to less of an effect on interest rates or more of an effect on foreign interest rates and less of an effect on exchange rates. I think what's nice about the papers today is that doesn't seem to be the case. If I look at the two papers which have something to say about this, basically in both cases I find that if the long rate goes down by, say, 100 basis points in the US, it goes down by about 40 basis points in other countries. With a lot of heterogeneity, we've seen that, but that's roughly the case. And that seems to be the same whether it's conventional or unconventional policy, at least that's the way I read the papers. So I think we can remove that. And so if there are differences, it must come from the different behavior of investors. And here I think there are good reasons why the investors should react differently to the same change in the long-term rate, depending on the source. Because what they care about is what happens to the long-term rate over time. This is where the capital gains and losses come from. And so it may well be that changes in the long-term rate coming from changes in the term premium do not lead to the same time series movement as changes in the long-term rate coming from expectations of short rates. Indeed, I think that's indeed the case. And if you read the newsletters that we all receive in the morning, there is a sense in which the Fed is really committed to having a fairly flat long-term rate. And therefore, the variance of the long-term rate is smaller, and the markets worry about the fact that this is leading investors to be too optimistic about the long-term rate not moving. And if it moves, it may lead to large movements. So I think that's part of the explanation for why the two are actually going to be different. The other is more general, is that the world in which the Fed, but the central banks in general, were intervening at the short end of the yield curve had become a very familiar world. They knew exactly. The guys in various financial institutions, were used to doing things one way. They kind of knew the correlations. They were fairly reliable. And this throws a lot of sand in all this. It changes the covariance structure. It changes the relative returns, the premium, and so on. And I think there's much more uncertainty about what's going to happen when the Fed or the central banks intervene in this way. So I think subjective uncertainty is a big deal. It might go away if we were to kind of do it for a long time, and people would learn. But at this stage, I think that's the difference. So I think that the case can be made on theoretical grounds that it should be different. How different is it? Well, that's where we got two answers, right? I think that it's fair to say that Steve didn't find much difference. And it's fair to say that Reuven found quite a bit of difference. And so this is something that requires another meeting and a meeting of the minds. But on this one, there is no meeting of the minds yet. Last, not least, so given the characterizations we've seen today, should something be done? And should there be coordination? So we've discussed the complaints of emerging markets. We've discussed the complaints of investors. I think in the case of investors, it's just that, again, it's an environment which they understand less, they have less experience, and so they complain. In the case of emerging markets, I think it's also a case not of subjective uncertainty, but the world is a more complicated place. Whether or not the Fed is doing unconventional monetary policy, you have more movements in exchange rates, in various macroeconomic variables. And so that makes life much harder for most of them. I think life is harder not so much because the Fed is doing what it is doing, just because the world is a more complicated place at this point. And the Fed is there to be accused, and that's how it happens. So at all the meetings that I've been at, I think every single one that I've been at for 7 years, there was a call for more coordination. We just can't let things go that way. And then I would push and I would ask, well, what does it mean? Well, more coordination. And you didn't know whether the Fed should do more, should do less. it just was completely unclear. And I think there's a good reason, is that the intellectual argument is actually very weak. The room for coordination may be there, but it's not obvious what it is. And so let me go through kind of one level of abstraction up. If you have a world in which central banks are inflation targeters and they care only about inflation, or they also care about the output gap, but there's what I've called the divine coincidence, which means that watching inflation is enough, then, then the Nash equilibrium, which presumably is what we're seeing, is efficient. And there's no way to improve on this. And the reason is that, there's one target, one instrument for each country. And the outcome is they cannot be improved on in terms of not making one country worse off. That's a very strong result, and it's a very good starting point. I heard, who was it? I can't remember today. I think it's Joe, who argued that maybe the central banks were not doing the right thing. That basically, because the exchange rate doesn't have much effect on the economy, which I don't agree with, but that was his statement, and the interest rate does, maybe they should use the interest rate more and the exchange rate less. So this would be a deviation from Nash in the sense that one central bank would be doing the wrong thing from its own point of view, but if they did the right thing, they should not complain. And the issue is they should first do the right thing and then find some reason to complain. Now, we know that that's too simple. We know that central banks, and I think rightly, care about inflation and care about the exchange rate, no matter what they say. Then in this case, it becomes less obvious. Again, as at the very abstract level, that doesn't invalidate the result in the sense that they have more than one instrument. They have monetary and fiscal policy. And in principle, you can use them to achieve whatever combination of inflation and exchange rates you want. And therefore, you still have two targets, two instruments, and the Nash is still efficient. Now, again, there are plenty of limits on what fiscal policy can do and monetary policy can do, but it's still a useful result. Now, is this the end? No. I mean, my sense is central banks care about the inflation target, they care about the exchange rate, and they care about capital flows per se, quite apart from the effect on the exchange rate, because when capital comes in, it changes the nature of financial intermediation, it complicates things, it creates bubbles, various things which are neither captured by the inflation or by the exchange rate. So I think in this case, the central banks are right to care about all three targets. And then there is an issue, which is that fiscal and money is only two instruments, and it can go wrong. But my sense is, and I think some people said the same thing today, there is a third instrument, which is capital controls. And if you don't like the capital flows, then use capital controls to keep them out. Again, under the assumption that capital controls work, you have three targets, three instruments. Your life is a bit more complex, but the Nash equilibrium is still efficient. So I think it's a useful set of steps. We can think of reasons why it's not enough, it's not the final answer, but you have, in order to basically say, well, there's a better way of doing things, you have to argue that one of these steps is not right, and that there is a major flaw in the argument, and therefore the Fed should do less and the Fed should do more. And I think that I haven't seen it yet. Again, that's a good topic for a later meeting. Thank you.
That's me. Okay. Thanks to Adam and Joe for inviting me to this panel, which is quite a challenge because it was supposed to be the wise man panel. So I hope not to fail. But anyway, I want to talk about two spillovers that I think that are quite important, which are what's going on in China with emerging markets and the prospect for U.S. monetary tightening. I will talk a little bit about some issues on coordination, then I'll go on China and then on monetary policy tightening in the U.S. before going towards some concluding comments. Now, this discussion about spillovers, it reminds me, it's a rediscovery of a very old issue in international macroeconomics, which is repercussions among open economies. Now the adjustment also, it's now, it's not the closed economy adjustment. There are global imbalances and countries must adjust. And we want prices to adjust, flows to adjust, and to have a adjustment with the lowest possible cost. In the recent discussion of Oliver, I got always confused. Let's assume that China and the US, they want, let's talk about big countries. So China and the US, Chile is a detail. But China and the US want to have a depreciated currency to push for exports. We have no solution to that. And that's a big problem. So we have to allow the adjustment to take place. Now, this is very old issue. And the question, why now we're so much worried? And we were not worried during the debt crisis. The trigger of the debt crisis was a Volcker disinflation, in which interest rates in the US were in less than 24 months, went up 10 percentage points. And of course, there was a lot of mishandling in Latin countries, but the final trigger was US monetary policy. And nobody said, well, let's discuss, sit in a table, Brazil and Argentina, Chile with the US, and let's coordinate monetary policy. Then the tequila crisis. The tequila crisis was late 1994, and during all 1994, the US was tightening monetary policy from 3% to 5.5%. Of course, in all those cases were countries with a lot of debt and dollar debt and with a mismanaged exchange rate, so they have a big collapse. Asia was different. Asia was more local, but then there was a lot of discussion because of contagion. It was not the spillovers, but it was contagion. And it was contagion from Asia to Russia and from Russia to Brazil. And there was a lot of academic papers. What did we learn? But the most contagion happens because of trade links. That's my reading. So I think that why now we rediscovered this, I don't know, but we can tell many stories. One thing is how the stages in the discussion of spillovers. And I think that there was some form of backfire because the first issue was China and currency manipulation. This was before the crisis, that China was doing currency manipulation, and this had a problem of competition for the US, and there was this big discussion, US-China, and then it came QE and currency wars. This was raised by Brazil because it had a very strong currency. And then, let me go, taper tantrum. And now all currencies in emerging market depreciated. And they say, well, we don't want currency wars, but please be careful. We don't want to go all the other way. So this is a very much international discussion without that much fundament. And then there is also the China deceleration. And all this discussion now, it's taking place also, which didn't happen before with the US center stage on the coordination needs and the impact of the US policy on the rest of the world. So I think that this is how I see this has evolved. And the two most recent and more important issues are what will happen with the US tightening and what's going on in China. Let me just make a couple of comments regarding China, because I think that's quite important. This is the IMF forecast. Okay, this is the world economy growing at about 3. Then it comes China decelerating. It's too wide, but it's China decelerating consistently since 2012 here. China decelerating, and then Brazil in a full recession. And this is until 2015, because next year will be another recession. So now, what is interesting about this is that China is 60% of emerging Asia, and Brazil is 40% of Latin America. So whenever we see emerging Asia in the data, it's China. And Latin America is in recession, it's Brazil. So what I did was very simple. I took them out. Okay, so what is surprising is there is a white that there, it's the color, that's not the color. But there is emerging Asia, excluding China, is extremely stable. 6.1%, between 6.1 and 6.3 since 2013. And Latin America, excluding Brazil, not in a recession, but falling at the same speed as China. What we said about this is commodities. Mostly this could be commodities, are much more exposed to commodities, Latin American economies than Asian economies. But as we saw from Ruben's paper, there is a lot of trade links with within Asian countries. So there is sort of it's not trivial to explain this difference. There is a lot of internal things in Latin America to explain this growth deceleration. So, of course, what happened with China since, and the timing, I'm a bit upset, since beginning of 2014, commodity prices have been falling sharply. Copper, food, oil, whatever. And this, of course, has had a lot of effects. What this has resulted, and I think that this is a very good development, a sharp depreciation. Going up is a depreciation. This is the emerging market way. A sharp depreciation of, yeah, we go up and when we depreciate. So this is a currency manipulation. We want weak currencies. So you say, this is 100 in January 2013. We have Brazil at 200. Yeah, they went from 2 to 4. It's huge, the depreciation. But we see it also in South Africa. This is the BRICS, not the BRICS, because Russia is out of it would distort the graph. And then you have all the rest of well-known emerging market economies, all of them with very sharp depreciation since the beginning, since the second quarter of 2013, which coincides with taper tantrum. Okay, so that's a link that I want to make, but it has a lot to do with the weakness. One thing that's important, and it's quite different from all of the other crises, 20 years ago, any official, policymaker, academic that would be given this graph would say there would be a financial crisis in all of these countries, except China, that is quite stable, okay? And huge increase in inflation. This was a story that we were using in the past, but of course it's not happening. It's not happening now. Despite this, which this is a good part of the adjustment, despite this, this is the case of Latin America. I didn't do it for all the countries, but we have that current accounts haven't adjusted. We want depreciation to make your currency weaker, and then you have an increase in net exports. But current accounts, in the case of Latin America, except for the case of Chile, have still at ranges of 5% in Colombia, despite a 70% depreciation in the last couple of years. There are lags, there are problems. The IMF in the last week said that this will take time, but this will happen. The adjustment in net export. It's not just commodities, because one of the countries that had the largest decline in commodity prices, in export prices, have been Chile, and it has contracted a lot, has increased net export. So this is, I think, that a challenge, a doubt, and something that is for the future to watch on the adjustment of the economies to this spillover coming from sharp decline, or it's not a sharp decline, slowdown in China to grow at more normal levels. Now, the next issue is what's happened with the U.S. monetary policy. What we want to avoid, or the main fear, which I think that is maybe a little bit exaggerated, but the main fear in emerging market is not to repeat what happened in taper tantrum. In taper tantrum, U.S., again, I see that, in taper tantrum, May 22nd, remind us, Ruben, Bernanke announced that they were thinking about withdrawing the excessive stimulus in the next coming month. They were buying $80 billion a month. They said, we will. And then what we had is, this should be the light. Yeah. No, this is, I think that I pressed the wrong key. No, but it always is not that. Okay, but there is an increase in March, in May 2013, and also the MB, the risk premium in emerging markets went up, all interest rate went up, currencies depreciated, and then we came from the currency war and to be more gradual with monetary policy, okay? Now, what happened actually was this. This is all emerging markets, I have the data following, but this emerging market, sharp depreciations and an increase in 10-year government bonds. The black dot is the US, so many countries had increasing in long-term rates more than the US, more than one coefficient in the previous regulations discussed, but this is for the taper tantrum, from April to November. So that's 6-month period. And then we had Just very few countries with a constant or declining long-term rates, and most countries also a sharp depreciation, a strong weakening of the currency. The exception were countries closer to Europe, because the euro at that time appreciated. And so, but we had all the countries, Asian countries and Latin American countries, with very sharp depreciation. So what we were looking for, which was, that's what I think that this has a lot of political things rather than strong economics. What we were complaining of very strong economies, of very strong currencies, turn around in a period of 6 months, but we were worried again. That was perhaps too much. Perhaps this is also related to what Olivier said, that still emerging markets float, but there is still some fear of floating. And this, I think, that has to do with what's happened in the more recent, and I will close with that. What's happened with the currencies, when I saw the first time this figure, and I found Chile kind of the exception, a country that interest rate goes down, and the exchange rate depreciates, which is the most expansionary movement in asset prices. I said that the difference of Chile with many other countries is that in Chile, when investors wants to go and to safe haven, since all investors in domestic bonds are Chileans, they go back to Chile. So we don't have any sales or so I said this may be related to foreign participation. I didn't have data by that time, but now I have data. I have data, so I did, and I said, and there is nothing. Foreign participation, depreciation, foreign participation. Now, there is one thing that is interesting, and I want to push it further, this graph is that foreign participation happens to be, this is the share of public debt held by foreigners. And this is very correlated in emerging markets with capital controls. So this may be a measure of capital controls or of the size of public debt and foreign participation. And we see that the size of the depreciation and the magnitude of the increasing interest rate is not much related to this. This is just one graph. There's no regression, controlling for many things, but just a first look at the data doesn't show that. And the second thing, which is also important, taper tantrum taught us that an increase in the US interest rates, it has repercussions, spillovers in all emerging markets, and with an increase in interest rate, which was contractionary. But at the same time, the depreciation of the currencies was expansionary. So at the end, the adjustment worked. What you need when interest rates are going up is to have some depreciation in order to keep financial conditions relatively constant. So let me conclude with what I think that in this context of spillovers and with the spillovers and depreciation, the challenge for emerging markets, and this is what we can see in Latin America. Latin America had very low interest rate except for Brazil, which is a special case. We won't talk so about Brazil. But it has an increasing inflation. The increase in inflation is mostly due to the depreciation of the currencies. And so now there is a problem for inflation targeters. The problem for inflation target is that you have a lot of inflation, which is a level effect. But you cannot explain people that 12-month inflation, 2 percentage points above target, is just a level effect. So there is credibility issues. It's quite difficult. So they have all inflation, except for the case of Mexico. All countries are outside their comfort zones. Chile, Colombia, close to 5% with a target of 3%. Peru at 4% with a target of 2%. Well, Brazil close to 10% with a target of 4.5%. Now, what that implies? That in this slowdown, with the slowdown from China that I already showed you, monetary policy should be loosening. And the good thing about the financial crisis, which was very tense, but was a lot of fun to run monetary policy, because it was trivial. Inflation was coming down, economies were collapsing, you just cut rates. You were very aggressive, and you say, well, you see inflation targets and everything works as we were taught by Olivier. So, so now it's completely different. Economies are decelerating, output gaps are widening in all the region, inflation is going up, and we see Peru and Colombia raising rates, and probably Chile will raise rates today. There is today we'll know, and I won't make comments about that. But it's a quite a challenge. And now the issue, in this case, the issue of capital controls, in this case, what you would need to do is to sell reserves and to try to engineer an appreciation. And in that case, I think that's very risky. This is what has been followed by Brazil. Many times in Latin America, try to control inflation via exchange rate is really a bad idea. So this is a very big challenge. Overall, I think that we will live with the repercussions. I am convinced we face some challenges. It's not trivial to do monetary policy. I think that fiscal policy is very difficult to implement. What we learned from the crisis is that it's very difficult to do a fiscal expansion. There is never a fiscal contraction. So we have this drift in fiscal policy. So we have a strong monetary policy. It's not easy to do it now. This is very much related what's going on today to the policy trilemma, to the issues raised by Ellen Ray, and which countries can really run effective macroeconomic policy, countries with strong fundamentals, of course, and can accommodate. They won't be able to avoid. We will have had even much worse crises from spillovers, the debt crisis, even in the tequila crisis. We suffer a lot, but still we live in a very interconnected world in which there is still many issues for monetary and macro policy in general. Thanks.
Okay, I apologize because I don't have a presentation to show you. I hope that means that it's a little bit shorter. I understood that it was going to be a round table, and so I thought that a few thoughts would just do for today. Let me touch on 4 issues that have been preempted in the previous presentations by a lot of the other panelists, but that I think are relevant and that we should keep on thinking about. The first one that I think is quite important is when we think about these unconventional policies, we need to think about the channel through which these policies work. So we saw a little bit of a discussion today about whether that channel was on the exchange rate, whether that channel was on foreign yields, and so on. But the way I'd like to think about this is to actually do something that Olivier mentioned, and it is to think about whether the policy has an impact on the current or expected future path of interest rates, or whether the policy has an impact on the term premia as it operates through portfolio balance effects. And I think this sort of sets the stage very differently between the unconventional policies that we've seen and the more conventional policies of the past that tend to concentrate on current interest rates and on forward guidance on where future interest rates are likely to be at. Now, as it turns out in the work that we've done, the two have very different impacts. They are very important for their impact on asset prices. I work in the financial industry, so I tend to spend more time thinking about what will impact on asset markets than directly on activity. And when I worry about activity, it is because of its indirect impact eventually on asset prices. But the reality is that when you look at the impact of some of these policies on asset prices, I find that term premia tends to have a much more important effect on emerging markets in general than the conventional policies do. Now, the reason why the term premia has a bigger impact, at least in the empirical work that we've done, is both of them have about the same type of impact on the exchange rate, actually. Okay, so it's difficult to distinguish the impact of movements in the. Think about a 10-year yield for a minute. Decompose a 10-year yield into the two components, the two traditional components. One is the path of expected future interest rates, the other one being the term premium. Suppose that for some reason you manage to decompose the two and get an empirical estimate of your term premium, which we tend to use work that's been done at the Fed on that, and then use that term premium and try to correlate that with these emerging market forces. And what we find is that the term premia and expected path of future interest rates have about the same impact. The betas have about the same betas on the exchange rate. And however, the beta on local yields, on local term premia, and is much, much higher, the one that comes from the external term premia, from the US term premia, sort of feeding on to emerging markets, than the impact that comes from the path of expected future interest rates feeding on to local yields. So in emerging markets, you have two forces there that are affecting the functioning of the local economy: the exchange rate in one direction, the interest rate or the yields in another direction. And that makes the term premia sort of a much more forceful force to reckon with. The second important thing is that while the beta on the exchange rate is about similar in between path of interest rates and term premia, what we've known since Campbell and Schiller is that the volatility of the term premia is much higher, and it actually explains a much larger fraction of the movements in the yield curve than the actual path of expected future interest rates. And this result has been validated in all kinds of different dimensions of work. Cochrane and Piazzesi and many others have found very similar results through different methodologies. And they all find that the term premia explains the lion's share of the movements in yields. And if U.S. yields matter for EM, then, and this is the elephant in the room, then what happens is that it's likely that the much greater volatility of term premia will end up having a much bigger impact ultimately on emerging markets exchange rates than what tends to be the smaller movements in the expected future path of interest rates. So the one conclusion that I drive out of this is, number one, that unconventional monetary policies have stronger spillover effects than do conventional monetary policies. Number two is that their impact happens to be very large because they tend to have a very large impact on the term premia, and that term premia is actually depressed. And number three, and here I reverse a little bit Olivier's question, is that why do we care for a given movement in the 10-year yield, whether it comes from the term premia or interest rates? I kind of turn that on its head and I ask, since I'm interested in the movement in interest rates, in the yields, where is that movement coming from? Is it coming from interest rates, or is it coming from the term premium? Because that ultimately, if I get a sense as to where the term premium is going to go, I'm going to get a sense as to whether the movement in the yield is going to be large or small. And so if you extrapolate that to the current episode that we are now anticipating of liftoff, then the answer is that you tend to think that liftoff is all about movements in the path of interest rates, much more than it is likely to be an impact on term premia, unless something happens that drives and then moves that term premia. And if you start thinking about what can drive the term premia, then you have to start thinking about the two factors that compose that term premia. The first one is the price of risk. If you want, you can call that the attitude towards risk aversion. And the other one is the quantity of risk that you effectively have. And that could be, for instance, the level of uncertainty over the path of future inflation, or the level of uncertainty that you may have on the path of the economy, the reaction function that the Fed might have in the future relative to these other components. But if you think about all these elements, and you think about the state of the world, and you think about the ECB conducting QE and the Bank of Japan conducting QE and potential enlargement of these programs for next year, then it's likely that we're going to continue to see a significant demand for duration out there in the market, significant demand keeping depressed the price of term, the price of risk in financial markets, and therefore the chances are that the movement that we see after liftoff are going to be much smaller. On the movements in 10-year yields are going to be much smaller per unit of movement of interest rates this time around than perhaps they were in previous episodes. And that leads me to expect, very much like we discussed before, that this is likely to be an episode that has relatively modest consequences once it unfolds, and that it has relatively modest consequences on other markets. But the point I'm making, the reason why I'm making this point is basically that I want to refocus and rethink a little bit the empirical exercises that we did today in trying to rethink about, okay, so a lot of these movements that we've seen in the last few years were in fact driven by major gyrations in term premia, and those gyrations had a significant impact on, were responsible for the significant spillover effects onto EM. And therefore, I think there's some reason why EM policymakers are right to be concerned about this, because the impact, as I argued, was quite large. Now, when we think about this, moving on to the second topic that I wanted to touch on, and this one is quicker, is that when you think about the movements, the spillover effects, it becomes critical, of course, what the exchange regime is. And we have all kinds of different exchange regimes out there, and people worry about these exchange regimes because of the price of the volatility of the exchange rate is not doesn't come free for a lot of these economies. It's an expensive thing for many of these economies to actually have significantly volatile exchange rates. Economies have, in many emerging markets economies, have had difficulties de-dollarizing or producing deep enough capital markets that can actually have the type of results that we've seen in Chile, and therefore the extensive volatility in the exchange rate can have significant impacts on expectations, on financial stability, and so on and so forth. So the one lesson that I draw out of this is that in the past, intervention that has been extensively used has been, a double-edged sword that has not always worked the way that we intended. Intervention, when capital is flowing in, has typically been perceived as, okay, it's at least slowing down the pace of appreciation of the currency. But the intervention brings also another factor, which is a feel-good factor. There's plenty of liquidity in the local economy that gets generated typically through this intervention. It's almost impossible normally to fully sterilize the intervention that takes place. And so as capital flows in, what you have is you have a boom in the local capital market and a boom in the local credit market. When capital starts flowing out, and the flows reverse, then we see reserves coming down. And when reserves come down, then there's panic. Then people worry about the outlook for the local economy. And very quickly, even though we may have very large stocks of reserves, people start calculating how many more months of intervention we have, and so on and so forth. Just witness China today, where we're sitting on $3.5 trillion of reserves, and we see a month of $100 billion of reserve losses, and we start calculating how many months of intervention at this pace they can actually endure, and so on and so forth. Right? So it's the kind of thing that I think the intervention can have some negative impact domestically. So if we're going to have managed exchange rates, then perhaps the next thing we need to do is also have some other policies that are conducted in a countercyclical fashion, like some macroprudential policies, to prevent a lot of domestic lending and a lot of booming in the domestic intermediation that takes place as capital flows in, and we try to sterilize some of that. And this issue of bringing prudential macro policies brings me to the third topic that I just wanted to throw out there that was also mentioned, and it is this possibility of bringing a larger number of instruments to address the larger number of targets that we have. And so Olivier mentioned this issue about the possibility of using monetary and fiscal combination to address exchange rates and the exchange rates and interest rates problems. Then we also have the problem of capital flows that he mentioned. For that, he suggested capital controls. I might argue that rather than capital controls, it may be intervention and macroprudential, but they are kind of like the same thing in the end. You could argue that there's a lot of other possible policies that you could use. Some countries have attempted to use sovereign wealth funds to capitalize sovereign wealth funds during the initial phases of accumulation, and then use the sovereign wealth funds to finance themselves on the way out. All these policies have issues. All these policies have problems. Flexibility in fiscal policy is very limited. It's very complicated to implement, as we're witnessing right now with the difficulties in Brazil to produce relatively moderate fiscal adjustments. So the issue is that whether we want to bring more tools or not to the table, the reality is that oftentimes the tools that we have are quite limited in scope, and it's difficult to use them effectively. And the fourth point that I just wanted to touch on, and Jose has mentioned some of that, and in the previous conversations we talked about that, is this idea that we've seen large capital outflows in the data, and that this may be, to some extent, anticipation of what's happening with the Fed. And I just wanted to at least share my thoughts on this very quickly. The first one is that the large capital outflows data that we see tend to be like a lot of the other growth data that Jose just showed us is infected by China. The reason why we have these huge capital outflows is precisely because China, for the last 15 months, has been having huge capital outflows. If you take China out of that equation, the drop in reserves and the actual magnitude of the capital outflows is much, much smaller, is much more manageable, and it's actually concentrated on a few more reasonably troubled emerging markets, or the usually troubled emerging markets, rather than this huge, humongous level of capital outflows that we're now estimating. So point number one is perhaps we need to filter out and do the thing Jose did, is just take China out, and maybe that will give us more reasonable estimates of what's happening with emerging markets flows. And the second thing is that we need to think about why is capital flowing out of China. If we think that capital is flowing out of China because markets are anticipating the Fed, then maybe we shouldn't take it out. But I really don't think that China's problems today have any connection with the Fed. Okay? I don't think that we can actually blame the FOMC or the ECB for China's lending boom since 2009, poor investment allocation, or any of the other problems that are perhaps behind the slowdown in growth today. So the issue here, again, is that we need to think about what drives this data that we're looking at, and I don't think it is very much an anticipation of nasty, complicated liftoff coming from the U.S., precisely because the markets are not tremendously worried so far about a potential jump in term premia. We may be surprised, but in principle, I think that we've seen a very sensible reaction on the part of markets in general in terms of the pricing of term premia, as we anticipate that the size of the Fed's balance sheet is likely to remain constant. The size of the ECB's balance sheet is likely to keep on growing, and the size of the Bank of Japan's balance sheet is likely to keep on growing. So bottom line is term premia is likely to remain depressed, and I don't think we should worry tremendously about that and the contagion to emerging markets coming from that. The contagion to emerging markets will remain very acute, but only because China remains in a dire situation. And I'll stop here.
Thank you. That was a lot of wisdom in a certain amount of time. Can I ask our three wise men or wise people to please ascend to the podium, and we'll take questions from the audience. I won't waste time with my questions since we're getting close to the end. Yeah, well, I'm supposed to round up. So let me open it up first here to Michael and then to Krishna.
So thanks very much for that. Jose posed the question, why are we worried now? And he said we can tell many stories. So I've got two stories. One is that, in fact, we were worried before, and we've tended to forget that, that there was blame on the U.S. But I think of another plausible story, I'd be interested in your reactions to that, is that we have to think about spillovers in the context of what's going on in domestic economies. And so do you think of these outcomes as bad luck or bad policy? And now it seems like it's more bad luck because a lot of, especially emerging markets, did what are considered the right things, and yet now they're facing this. Whereas if you think about previous crises, there are obvious vulnerabilities that they had. So maybe this is less true in Europe because there, among some countries in Europe there are these, but among emerging markets they built up reserves, they brought down inflation, there's a lot of fiscal consolidation, and yet now, because of bad luck, not bad policies. So maybe part of this, concern is just one that even when we do the stuff right, there are these spillovers that can come and plague us.
Yeah, I fully agree. I didn't want to turn my hypothesis, but I think you're completely right. Today, emerging markets have problems because of bad luck from the spillovers. In the debt crisis, there was a lot of distortions. And then there is the other issue that you mentioned, and this is now the creator of the spillovers is also the originator of the crisis. So this didn't happen. This in the past was just you were takers of good policies from developed countries. So, yeah, I agree.
I'd like to just to warm up the conversation a little bit. I'd like to disagree with that.
Turn on your mic.
Yes.
Thank you.
There we go. So I'd like to disagree with that on the basis that a lot of the countries that have problems today are guys that didn't do things the right way necessarily, right? It's one thing when you think about the broad guidelines of the framework. Okay, yes, they have inflation target and they have floating exchange rates. They've had a better structure of the debt and they have a more sensible fiscal policy. But think for a minute about, for instance, the specifics of some of these countries. They've been running down their fiscal cushions significantly. Brazil, 3.5% of GDP of deterioration in the primary surplus in the last 4 years. Debt to GDP ratios growing by about 10 points in both Brazil and Mexico in the last few years. The marginal cost of debt, not the marginal cost, the average cost of debt in Brazil remains very closely linked to the short-term interest rate. So they didn't go as far as they should have in delinking their debt from the cost of funding. They have very large stocks of reserves, but they've also used up about 25% of those reserves in currency intervention that wasn't all that well planned. So it's if you think about where the vulnerabilities are today, we're not in the 80s, and we're certainly not Asia 1997. But I think since the crisis, the change in policies that took place in emerging markets weakened the framework significantly, and we're now being the consequences given this level of weakness. So we're not going to have a crisis like the good old emerging market crisis probably, but the places that have difficulties associated to the magnitude of the deviation that they had from the type of policies that Jose was talking about were in place at the time of the 2009 reaction that Jose spearheaded in Chile.
Just one small point. I fully agree with you that the conditions in many emerging markets have deteriorated a lot. And just one thing, but that doesn't mean that countries that are complaining about the spillovers, China, India, Brazil is not complaining because they know that the problem is theirs. So I was trying to understand why countries, emerging markets are complaining about spillovers, and those weak, like Brazil, that was the champion of the currency war. Yeah. So it was closer to a currency suicide than a war.
Sergio. one of the running jokes at the fund was when the WEO and the GFSR were presented, and each quarter or each semester for the actual documents, Jose would come out saying it was the end of the world, and the WEO would say, well, our baseline is fine. And I have a bit of the same sense, which is it's not obvious to me that the risks are bigger now than they were at many points in the last 6 years. The nature of the risks changes, so the discussion changes. It's clear that the falling commodity prices has shifted the risks towards the emerging markets rather than the advanced economies. So the discussion is different. Some people worry about China. Some people worry about liftoff along the lines we discussed. I don't have a sense that the risks are bigger now than at any point in the past, and I don't think that what we discussed about conventional or unconventional monetary policy is very important at this point.
Okay, there are two people at that table. If you could, he's got the mic and then across. And let's get both questions if we could, please.
Thanks. Yeah, I wanted to return to an issue I'd raised earlier, but in the complexity of my question it got, I think, lost, which is in the financial markets right now, there is a lot of sort of concern and speculation about the nature of spillbacks from the current difficulties in emerging markets to risk premia in the core of the system. One sort of channel is the idea that the difficult adjustments in emerging markets could promote risk aversion, leading to rises in, say, equity risk premia, credit risk premia, and so forth. The other is this idea that the rundown of reserves, in some sense, in some partial degree at least, represents an anti-QE, or a quantitative tightening, as it was branded by one firm. I'd be interested in the panelists' thoughts on these questions, whether it's duration risk or whether it's equity or credit risk, how these EM developments might spill back to the core, to the US and other industrialized economies.
So this is a question just towards Guillermo Medino's presentation. I was just wondering, first as a specific question, it seems like your results that the effects on EMEs arising from the term premium component of changes in yields associated with monetary policy actions is much greater in the EMEs than of the expected policy rate component. And that contrasts with the results in a recent study by several IMF authors, including, I believe it's Chen, Grafoli, Massini, and Ratna Sahay, where they found that the expected path component is much more consequential. So I was wondering if you had any insight into what could account for those for that disparity. The second closely related question is, how much confidence do you have in the decompositions afforded by term structure models, particularly in an environment where central banks have been engaged in much more aggressive forms of forward guidance than in the past?
I'm not sure anyone on this panel should be defending forward guidance at this particular moment, but please go. Guillermo.
Two thoughts real quick. I certainly have limited confidence on these models that decompose the term premia and the expected future path of interest rates. But there's several different ways in which you can go about this that go from brute force analysis of 5-year forwards, the difference between the 1 year, 6-year forward and the 1 year, 7-year forward, and whether that has information on the term premia. Presumably there's very limited information on where interest rates are going to be that far out. You can look at the information on just the slope of the yield curve more generally. All those methods have shortcomings, all those methods have problems, but they all yield a pretty similar result with a major fall in term premia during the quantitative easing period, or at least the unconventional monetary policy period. And all those methods show that the component that you kind of identify more as term premia has a larger beta at the time of explaining the movements in local bond yields. We looked at the correlation between our estimates of local term premia and estimates of term premia for the US, for Germany, and so on. For all the countries that we've done this type of exercises, and the answer is they usually come out much more significant than any component that comes from the path of interest rates that you can derive from the residual of some of these methods. So the answer is you have to be very careful in interpreting some of these things, but they're kind of intuitive, and at least I find the answers to make some sense and to kind of match the theoretical arguments I would have made. The second point that was raised is this issue whether we could be facing a different episode now where contagion is coming from reserve losses in emerging markets to and therefore liquidation of treasuries and some of the assets that they own. Again, I mean, the guys that are buying those the dollars away from China are not sitting on cash, right? So those guys are buying something in exchange for that. What are they buying in exchange for that? It may be a different composition of a portfolio. They may be buying apartments on Fifth Avenue, San Francisco, and London, or they may be buying equities, or they may be buying some treasuries. So I would expect that this is not going to have a major impact on global risk premia in a negative direction, because I think this is just a change of hands in terms of what happens with that. So in terms of that specific issue. Now, I do think that if we get capital outflows in large scale out of China, out of concerns on the macroeconomics in China, then that is a risk for the global economy, and that should have an impact on global risk premium. Okay? But I don't think it's this quantitative tightening argument that makes sense, right? I think what makes sense is here we have a fundamental source of concerns that we should be looking at and could actually drive effectively term premium. And the final argument is that it's very difficult to argue about quantitative tightening in a world where 10-year yields are 2%. So we have not really moved. The arguments that people use to explain this are just some spreads between treasuries and swaps and so on that I am sure that you can explain much better through microstructural arguments than through this type of episode.
Great. Jose, Olivier, do you want to add anything on these issues?
No, this I will pass to Olivier.
On spillbacks, I mean, I think the word was actually invented at the fund, if I'm right. And I've been typically skeptical of their scale. I mean, if we define spillbacks as something which happens here, goes there, and then comes back, then I think when it comes back, there's not much happening. Of the channels that people are mentioning, one is the balance sheet effect due to the dollar appreciation. And my sense, reading the data, is that that's an issue, but not a big issue for the US coming back. And the other is the loss of reserves, of a decrease in reserves, a decrease in sovereign wealth fund accumulation. I think even if you forget what I'm just going to say in a second, I think the effect is not very large quantitatively. And also, when reserves go down or when a sovereign wealth fund accumulates less or decumulates, somebody else accumulates. And so the important issue is what is the composition of a portfolio the people accumulate. And I see no reason to think that this will have major macroeconomic effects. So spillbacks, I'm not terribly worried about. I think spillovers from the rest of the world to the US, then, this is the kind of catastrophic China scenarios, this can be very big. But the spillback itself, I'm skeptical.
Great. I'm going to close it there. I'm going to give my thanks, particularly to this panel, to Joseph Gagnon, who pulled this together, to all our guests and speakers. I think it was an incredibly substantive day, and I'm grateful to everyone for their blend of analysis, relevance and, dare I say, wisdom. Just again, an advertisement. We are planning to do a larger scale conference on the related theme of monetary policy options for the small open economies in the spring, right before the Fund Bank spring meetings. A couple of major central bank governors from minor countries will be there to explain their dilemmas. Sorry. You're correct. Thank you, Ted, for teaching me diplomacy, which I need. You're absolutely right. So on that note, that I should be more diplomatic, but we have much more to talk about. This meeting is adjourned.
Thank you.